Okay, good afternoon, guys. Well, early evening, I guess. A little bit of a change in time with the difference in the US time zones in a minute for the Fed meetings. But here we are again. It'll be interesting today. Interesting for a lot of reasons. Obviously, we've got Yellen's first real kind of, in charge meeting of the Fed tonight. So it's going to be interesting to see what tact, if any, she actually takes. So I don't think we're going to see many surprises, but it's always worth joining these live sessions because we've certainly made some money in the past. Some interesting kind of rhetoric, some interesting kind of thoughts I'm going to go through just to kind of build a bit of a bigger picture about these things. Obviously, we've got the geopolitical events in Ukraine, which is putting a slight skew on what could happen. But we'll talk about that in a minute. What I'll do is I'll just quickly go through the basics and the risk warning, and then we can answer any questions and get to the meat and bones of these things. So before I start, as always, the risk warning. Remember, the spread betting CFD trading will carry high risk or capital. Resulting losses to exceed your initial deposit. We have a simple for everyone, so please ensure you fully understand the risks involved. The information code is provided here, and under no circumstances are considered an offer or solicitation to invest. Nothing here should be construed investment advice. The information provided is to be accurate to the data it is produced. Education only. Content about close opinion from moderated at iTrade.com. Content is not close to United investment tax advice. Individual comments not accepted only by the typical content of the No, it's harder saying that. So what we're going to do, we're going to do some live charting analysis, which will be based on the fundamental data. So I'll go through some different time frames if we've got time. But again, with this being a live session, what I'll do is I'll try and show you the market where we could potentially push to if something does the market today. And then again, with a little smaller time frame in order to balance out what's happening. I've been using some simple calls on just doing some simple things with this added volatility we've seen, and I still can't believe the more people just aren't using the simple basic technical tools that are available to everyone. So Fibonacci, Bollinger Bands, and really just some good levels of support and resistance. I mean, them three things alone will allow you to trade any kind of volatility, but also trade any kind of real-time news. So I think trading, we need to go back to basics right now. A lot of people are asking me what the stop should be, how to cope with volatility, how to not get, stopped out of trades, how not to take big losers. Well, the fact of the matter is, not to take big losers means that you have to keep a relatively tight stop and make sure your stop's in the market and so you don't overexpose yourself. The fact of the matter is, it's your choice how much you trade and how long you stay in trades for. But the more time you hold a position, the more risk you're exposed to. And the bigger the size, the more your potential downside is compared to your upside. So it's going back to the one-on-ones of trading right now. When we've got key fundamental geopolitical events happening like the Ukraine-Russia standoff, and we've got, the kind of relative uncertainty still left in the market, and issues like tonight, where we've got, Yellen coming in, and the Fed, really kind of trying to hammer home the quantitative easing tapering. All these things, none of them are good. Yet gold seems to be selling off and the market seems to be still creeping higher. Kind of in opposite land at the minute. So it's not very easy to determine the fundamentals and the technicals and try and get that balance. So I'm just looking at the markets right now. I'm just going to look at the S&P, the euro, dollar, and gold. So again, the S&P, we're still, I'm just putting on the hourly chart, so we're still getting towards these highs. I don't understand why the market's still pushing up. What I have learned to do is stop selling them. That's what I've done, because like everybody else, there's been some big moves in the FTSE. There's been some real huge kind of spikes that would push even the most tried and tested of traders out. So I'm just trying to pick out the nice trades, pick out the low kind of resistance trades, and certainly not overtrade. I'll be lucky if I put 2 trades on a week at the minute. So you can see the S&P still, has remained strong. You want to see if Fibonacci works? Well, here we go. I'll show you in real time. Here we go. Big spike up. Market comes back down. So you do a Fibonacci from there to there. 50%. Market just touches it. Market doesn't close below 50%, makes a new high. Okay, so that's how to do a Fibonacci from that move. You want to do a Fibonacci from where we are now? More recent terms. Okay, well, the market found support, I would say. Let me just see. No, what I'd do is I'd say the up move really started here. Okay, so we continue to make these highs. And we're doing to the current highs that were made. The market can't get back into this range here. Can't get back to the 50%. Can't get back to the 38.2. Touch the 23.6 to the pip. So what does S&P? What does it do? If no other data comes into the market and it can't get back to that 50%, all these hours of trading, what it has to do is the S&P has to make a higher high. Yeah. So the only kind of real target we've got is 188.20. So the rules of Fibonacci don't really change. We ripple through the market. So did a Fibonacci from here to here, above the 50%, market makes new high. But all these hours of trading going back to the 18th of March, so a good full solid day's worth of data. Okay, we haven't got back into this range of this spike up. Okay, these 3, 4, 5 hours of solid buying. Couldn't get back to the 50%. Couldn't close below the 8.2, and couldn't get back to the 23.6. That acted as real key support. So if we hear nothing negative today, then the S&P has to make a new high. That's how Fibonacci works. You do the same kind of thing on all the charts, really, but we haven't really got kind of time to go through that and kind of go through the Fib lesson. That'll be for another trading clinic on FX Street at some point in the month. But it's going back to the basics of trading. Try not to close, but within the hourly lows of the market here, so the market pushes up. So where does it look to hit? Well, the higher levels. It's as simple as that. Look at the Bollinger Bands work. And the moving average then becomes a support point. Even though we break through here, it comes back to be support. Channeling that the market has to go up. So if you just use Fibonacci like that and Bollinger Bands, well, again, many a times, look, 1, 2, 3, 4 times tries to break lower. Market then finally does, but closes towards a weekly support point. Next candle opens, straight back up, aims for the moving average. So you have to have Bollinger Bands on your hourlies. And I don't know of any other way or any other kind of reason why you wouldn't. It shows you the tops and the bottoms, and every time we try and push and close out the Bollinger Bands, we generally, when we close back inside, hit the moving average fairly quickly. Again, gold, we've seen on a bit of a downward tumble yet again. It's following the lower end of the Bollinger Band as kind of support, again as a downward target. Moving average is acting as resistance. Again, it doesn't make any difference. You can look for the market to break 1332, look for the market to get back to the full fib of this big hourly move or the weekly resistance. But you wouldn't want to be buying it here, really, would you? You'd want it to test lower before you find them overall, kind of like proper support points in the market where we get a good, solid reversal back up. So all the moving averages now, we're well away from it now. So what I would do is, for these kind of situations, to get a bit of more confirmation, just put things like your RSI and your demarcation on. So, look, we're massively due for a bull reversal at some point. The demarker, is literally, at 0.9. Okay, this is a scale of 1 to 100. So 50 is the midpoint, 100 is massively overbought, so bear reversal, 0 is an absolute bull reversal. So we're going to get a spike in gold back up at some point. Again, but we're still just trickling lower in the RSI, so we're not massively oversold, but we're due for a reversal. So instead of trying to buy gold where we're trading here, look to buy gold lower down, maybe 1321. Because what the market will always do at the final point, push lower to get the longs out of the market and then spike back up. So when any times people say, well, I always stop out of trades, well, you've got the wrong entry point, or you don't use small enough size to average into these danger zones, because all these levels are here to be broken, because the market's moving aggressively down. So instead of being bounce levels to go back up, the break levels until we find the market with that good support and push it back up. So it's not easy. Listen, guys, trading was easy. We'd all be sat in the back of our yacht, and it would be very easy. But, again, the way I use my charts and the way I put Fibonacci in, we've closed below the 50%, so all the levels are acting as resistance, okay? So I'm not going to do anything until we hit the complete 423 spot 6 retracement, which is at 1324 spot 98. Until that happens, I'm not going to do anything, because I know I'm going to be buying, and the market can still potentially go lower. Look, it's heading for these levels right now. So we've got 6 minutes before Felon? That could be a Freudian slip, couldn't it? Before Yellen speaks. There's a couple of things I wanted to go through. So generally, it's expected no change. The taper is expected to go down by another 10 billion to 55. But really what we're looking at now is his forward guidance. What Mark Carney and Mario Draghi were so bad at, and certainly Ben Bernanke was very cagey at, Felon's got to be better. Okay, she has to be better at forward guidance and giving the market some idea of what's going to happen. Now, the Fed, just like the UK, have tied their interest rate decisions around unemployment. So unemployment, the threshold is 6.5. Okay, we dipped down to 6.6, and we're kind of hovering around there. So it's likely that soon, with the kind of better than expected job numbers we saw from the non-farm payroll, that we're going to get below that threshold. So the forward guidance has to come into play, and Yellen's going to tell us what she's planning to do. The weather was to blame for a lot of the bad data that's come out, but we're still expected to see 3% growth out of the US. So it's not all bad news. Inflation's still well anchored below the 2.5%, 2% kind of level. So it's what we're looking for now is Yellen to say, are we going to continue on this ultra accommodative stance, or are we going to change to something else? Because really for me, after the kind of Fed meeting in January, everybody knows that we're going to generally have to get to that point where unemployment is better and then self-supporting, as we will do in the UK. And Mark Carney, again, instantly regretted his decision to link unemployment to interest rates. And all the measures that were took and all the billions and billions and billions and billions of dollars that were pumped into the US means that, yes, jobs had to get better, or else it was game over for everybody. So right now, it's all about this new kind of term that's coming into the market, which is qualitative rather than quantitative easing. Now, I'll just read you a piece that I read that I found quite interesting. And it says there's been a change in tax from other officials, calling for qualitative easing rather than quantitative policy moving forward. And this means that the method is focusing on the number of frequencies rather than the meaning and experience, whereas qualitative methods point to the ability of collecting data which are concerned with describing meaning rather than drawing statistical inferences. Typical Fed speak, massively overcomplicated. It's trying to figure out, instead of just going off data and what the data tells us, really interpreting what that data means in the broader spectrum, and then going off that. Well, isn't that just common sense? I would think that's common sense for me, guys, to be honest. But, again, all these officials, all these people in power like to overcomplicate things. Really, the rationale should be that, yes, non-farm payroll might have been worse than expected because of the weather, but then we have the revision, and then we have the next non-farm payroll that's still better. So I don't think the weather's got much to do with it, to be honest. I think the US is just masked a lot of problems and still struggling. So why the stock markets remain high? Do you know what? I don't know. Every 6 years, the FTSE has a big correction. We're in the 5th year. So you don't need me to tell you these things. Things move in cycles. What goes up will go down. The harder and faster it goes up, the harder and faster it goes down. So interesting what's going to happen from Yellen today and what she's going to say. We might get a little bit more meaning to what she's going to say from the meeting afterwards. But right now, I'm not expecting a great deal, but it doesn't mean there won't be rumours and volatility flying through the market. I would expect that if we do hear some fairly dovish news, we're going to see a spike in the S&P, and that will trigger gold to sell off to these low levels. But again, as we're massively, due for a bear reversal, I'd be buying any kind of major dips in gold. So I've got all the charts up, I've got all my accounts open, so gold spikes down. Do you know what? We might see an overextension and a good opportunity down here to buy. And I always keep gold open over these Fed minutes because it's a very volatile and vicious move. So we've got to be careful. So let me just keep the screens nice and wide so I can see all the levels. Okay, euro dollar. I'm still massively negative the euro dollar. We've seen a big move in the Canadian currency, so that might be signaling to me that there's things going beyond our means in the central bank. There's a big rumour right now why the euro is being pushed up so much. It's because China are liquidating dollar positions and hedging into the euro. So that's the reason why we're seeing such strong positive kind of gains in the euro against the dollar. So again, all these things put into the mix. But right now, back to focusing on what is going to come out of this Fed decision. Everyone's generally expecting no real change, but you could always get that surprise. And it doesn't really matter if nothing does happen. There will be the odd comment. There will be something that comes out immediately afterwards that can move the market. So we have to be ready. So remember, have your levels on the upside and downside. Don't try and go with any initial spikes. Okay? 9 times out of 10, you're going to get in when people are getting out. It won't do you any good. So let's wait for the first spike, for something to sell off or to bid up, and see if we can pick one of these 3 products where we can find some value. Okay, guys, so not long now, so I'm just going to listen to the squawk. I'll shout out if I hear anything of major significance, but let's just watch the screens, watch the market. Nothing else is going to particularly, I would stay away from the Dow. So look at the S&P, look at the euro dollar and gold. We'll just see exactly what's said and what will come from this. 10 seconds now, guys. Okay, a 1.38743. So a bit of strength coming into the dollar, euro's weakening. Okay, watch the S&P to hit these lower levels now. If we start to see the market break through the lower Bollinger Band, 186561 is a target. Okay, so we reduced purchase 30 billion, as we said. Fed fund rate is staying at 1%. See, you can watch these spikes now in the euro. Okay, so strength coming in, seeing that weakness in the S&P, but look for the 138743 level in the euro dollar. That might be a sneaky buy. Long-term jobless rate 5.2%. Okay, so watch. Let's say S&P selling off now. Okay, but watch. Be very, very careful because gold's still going down as well. Natural bit of a sell from the S&P, I guess. I don't think the data on what's been said is particularly bad. There's been no change. So we're talking about what's happening, what's being said now in real time, the comments that are coming off the back of this. So it's understanding what the kind of subtext of this decision is. Okay, so again, watch, we're really pushing down. So it might be a little buy in the euro dollar down here. So labour market on balance has improved. Fed fund rate is below normal, even once employment has increased. So still, on that very, very accommodative stance. So again, could see some further weakness in gold off that. Rate rise at the end of 2015 rather than the beginning. So rate rise back. So again, good news. Okay, got a bit of a mixed bag though, really. Okay, so again, we've seen that although the kind of noises that have come after that unchanged are basically that things seem to be fairly steady. So maybe this is just a natural reaction to kind of, take some profit in the S&P now. So interesting that gold hasn't sold off further. I would have thought that on relatively in line with expectations. Again, as I said, we didn't quite reach that low level in the euro dollar at 138743, but still, would have been a nice area to buy. We've seen the S&P kind of bounce back off these lower levels now, so don't be surprised if we make a fresh high in the S&P now. Because there's nothing really that came out of them comments that were particularly bad news. Basically just saying we're staying on course, rate rise won't be until the end of 2015 if at all, and we're still fairly accommodative. So still good news for the market. So surprised the S&P kind of dipped down though. Gold's trying to hit these lows now, 132, so 132498 and 132178. If gold gets down here and blasts through that, we could get down to 1297, which is fairly good news, I would say. So half tempted to buy if we touch back again at 186870 in the S&P, because I do think we're due for a new high, and then I think gold's ready for a trigger to go down. But S&P is still moving down right now, so again, it's still kind of keep these things in focus. Yep, dollar's up for its gal, absolutely, and she's got the press conference in half an hour. Yep, that's exactly right. So we're seeing that weakness coming to the dollar. Strength coming to the dollar, weakness obviously in the euro. So the euro is, pushing down. So it'll be interesting to see if we do break 138743. So we've got quite a big gap to fill and quite a number of levels down here. So I like to see them quick snapbacks. That's why I'm looking on the hourly chart so we can see as much as we can. I like them quick snapbacks. I don't want to be, buying here and holding the bait. So we're right on that level now. As I said, we would be 138745. So if we don't break this now, we could see a nice strong bounce back. We do see some euros buyers, but then there we go. That's when big players are in the market, when we see these big attempts to break key levels. Now again, the way I use Fibonacci, the way I set the charts up, all these levels are key that we're touching right now. Okay? They're not just coincidence. There's no reason. There was a very solid reason why we paused on that level. It's a big, big level. So in the euro, if we're going to get it down, I wouldn't be buying until down here. So another 38, 35 ticks we could potentially drop now in the euro. So again, this might be an opportunity. Remember how the markets work. We're not just talking about individuals. World banks, big hedge funds, people will be listening to what's been said out of that meeting and making the decision. So if you've been long the euro for the last few weeks and there's relatively good news come out of the Fed that we're not rocking the boat, we're keeping on the quantitative easing, we're doing the 10 billion as we kept said, we think the economy's going to be okay, so bang, you're out that euro, you're turning and reversing and slamming into it. That's why you're seeing the euro weakness. Don't quite understand why the S&P is still pushing down, but as I said, the markets are too high anyway. And remember, a lot of people that are bought on that will have been squeezed out of that position right now. Gold still is having a little test low and have a little look. We're holding on that 1332 level. And if we pop below that, we've got the full retracement target, massive target here. So I certainly wouldn't be buying any gold right now. But would I want to sell it there? No. But that's the whole point. I mean, again, I said we could have bought the euro here. I knew that because I know it's a good level. But already, we're pushing people through it. So if you've got a relatively normal stop, then you're out. If you've got a 10-tick stop, you're out. So this could easily be pushed down to these levels down here. And I don't think we'll get down to these lower levels, but you never know. I mean, again, to say that nothing has been really said and that, an unchanged decision doesn't move the markets. Well, the markets have moved more than they've moved all day. Again, S&P seems to be selling off. So if we go below this level here, 180, 60.61. Okay, that is the next logical target. The market will push on the hourly charts. Gold, again, is just hesitating, not really doing anything. Will the euro go down with her speech coming? Absolutely, it may do. It just depends what she says. I mean, maybe this is people anticipating that whatever Yellen said is going to be good. Again, look, we're breaking through the S&P levels here. So I'll tell you what, I'll buy the S&P down at 1860, 61, because that's what it's going to test. Well, in fact, let me see if it test that, and I might buy it at 1859. But I'm telling you in real time where the market's going to go. This isn't coincidence. It isn't by accident. You need to set up your charts in these kind of ways and look at the hourly levels, because that's what big traders look at. So they're going to push it through, lower the Bollinger Band, get back into that range, and we know this is 50% of that big move. So the S&P, don't really understand why we're still, again, there's no point sometimes, trying to analyze these things too much real time. Just watch what the market's doing and get on board, okay? That's all you can do. The time for analysing these things is after Yellen spoke in half an hour. What we're trying to do now is predict the future and try and find some value. So we're still fairly heavy in the S&P. So I'd like to see it test that 1860, 61, see what it does though. Again, we're just kind of holding towards the lows in the euro dollar. I think we're going to push a little bit lower. Okay, so again, we're getting towards these lows in the S&P, so we want them little kind of just jolts in the low, where we're just getting people taking away them lower orders to buy, and the market just to hammer through. Yeah, absolutely, Farid Skal. I mean, the market generally prices these things in. That's why I trade in futures, because, that's where the market's really at, in the future prices. So what we're expecting the Fed to do, the Fed to come out and say, yeah, we're not going to bother with quantitative easing anymore. Tapering the quantitative easing, we're going to keep it just in case. Okay, so we're getting towards these lows now. So watch what the reaction of the market at 1860. Also, again, just if we dip back up to this 1387.43 in the euro dollar, I just feel that there's still some big euro buyers out there, so we might find some short-term value and just to push it back up. So interesting in the short term, really. Again, I would take this as relatively good news, so I'd expect gold to continue to fall down and the S&P really to kind of find some value around these levels. But very, very difficult to know exactly when to buy. I mean, again, we've only got 21 minutes before Yellen speaks, so this might be big players positioning before that. But realistically, you could have got short against the S&P beforehand, but there'd be nothing signaling me from the comments after the unchanged decision that the market really should sell off significantly and stay down, more importantly. What does everybody else think then? What does anybody think of what's been said after the Fed decision? Again, I mean, we still have a big mix in the Fed. We've still got a lot of hawks, a lot of dopes, a lot of people talking about the economy, but a lot of people at the same time thinking and saying that, the quantitative easing, once that's gone, what's next? What after that? How can the markets go back to being self-supporting with such a big influx of money? And it's a valid argument. You know, it's like people kept, you know, comparing the markets and quantitative easing to heroin. You don't just suddenly take away all this money every month, you know, that's compounding, and then expect the markets to be self-fulfilling. So I still think we've got lower to go in the euro dollar. But again, the S&P starting to kind of take away, you know, them gains again. If you bought at these fib levels, that, you know, these are what you're trying to target, you know, for the bounce backs and get back to the 50%. Gold, really not doing anything. I'm very surprised that we've seen a big sell-off in gold. We haven't seen any attempt by big players to move gold around at all. Okay, dollar strength, euro bearish still. Yeah, seems to be. I mean, we've still got, again, remember, you know, this kind of, I was writing a piece this morning for the press about Ukraine and the situation in Russia. And when you talk about sanctions, you know, the press love to build these things up. The sanctions only affected 21 people. You know, do you really think Putin's going to be frightened about, you know, 11 diplomats and 21 people having their assets frozen? No, he owns these people. He owns them all. He owns all of Russia. So they'll do whatever they're told to do. These imposed, increased sanctions only affect 100 people. Okay? You've got to remember, there's a lot of Russian money in London. Okay? We've got a massive reliance in England and Europe on Russian power. Okay? We all know the effect of inflation. We all know our bills are going up. If Russia turn off the taps, we're all in trouble. So realistically, Team, you know, America, world police, they can do whatever they want. They're not going to spark a new Cold War, I don't think. But it's going to make things a lot harder in the UK and Europe when times are already tough. So I don't really think that we have that much maneuver in Europe and the UK to kind of really take on Russia over this, you know, this particular incident, to be honest. But that's just my personal opinion. Yeah, I mean, Russia is called a corrupt gas station. Yeah, absolutely, it is. I mean, again, remember, you know, the majority of money is held by a very small percent of the population in Russia. It's just as simple as that. And what can we do? You know, we're all very kind of keen to go green and use wind farms and wind down our nuclear programs. But once you've done that, then you're at the mercy of people that supply the power. You know, to start up our nuclear program will cost a lot of money, and it's going to take time if people are opposed to it. But we all like cheap energy. That's for sure, don't we? So we're still seeing that weakness, as I said, in the euro now. So we're still seeing the dollar spike up. We get down to these levels down here, I'm definitely going to start buying some euro dollar. Definitely. I'd like to see it spike down there quicker, though. I hate this small grind. If we get down to it in tick, you can just see the market blipping through. If we get down there fairly quickly, you know, with being only 17 minutes till the next kind of Yellen speech and the rest of, you know, the kind of candlestick formations coming in, then I definitely, if we get there in the next couple of minutes, we're buying some down here. So we're still hovering on the 161 fib, the S&P. Still don't fancy a buy, though, to be honest. Gold, not doing anything until we touch this lower fib. Not doing anything at all. Yeah, I mean, again, it's a bit of a stand-up, isn't it? Yeah, absolutely, Forex Gal. To be honest, the world's such a fragile place right now that nobody wants to rock the boat. Even America don't want to start, you know, getting to a heavily, you know, mission where they have to go across to Europe and put troops down. Nobody wants that. We can't be bothered. You know, it's cost too much money. We've got too big things to worry about. Putin's a madman. Okay, no matter how you look at it, he's out for his own agenda. And if anything, that when you look at Russia, it's like they're addicted to being on the world stage, aren't they? They're addicted to the limelight. You know, with the Olympics and Sochi, they kind of got a taste for it. You know, they let them political prisoners go, let that brilliant, you know, Russian billionaire go, and they're kind of like, look, aren't we civilized? Sochi's over, we're bored now, right, bang, next thing, Ukraine, have them. Crimea, that's it, we're out there, we're having them. And it's like, yeah, all they're trying to do is be in the limelight and reaffirm that they're a world power. Okay, they are a world power. They've got, you know, massive resources, and they've also got nuclear weapons. But when the majority of your population are grubbing around in fields in a skin, no, that's not an equal society. That's unsustainable. That's the same reason and rationale that are used for the emerging markets in China. There might be billions of them. They might be the biggest monetary economy when you talk about it in that scale. But the GDP per head in China is $4,500. GDP per head per capita in the US is $45,000. Who's got more power? Okay? If we stop buying, China doesn't exist. If we stop buying iPhones, new plasma tellies, then China's built on growth. It's built on the US consumerism. Okay? Global consumerism. If that goes, China goes. It doesn't have the internal power to support itself. Okay. Yeah, absolutely, absolutely. Well, we can go on and say things about Putin all day long, but the fact of the matter is, he controls Russia. It's like the Alex Ferguson of the football world. He has complete control over Russia, and people follow him implicitly. So, what can we do? And while he's got, he's got the oil, and he's got the rest of the, Europe and the UK on tap, and over, excuse the pun, a barrel. What can we do? What we have to do is go out into industry and build these electric cars we're meant to all be driving, or stop this reliance on fossil fuels. We do that. Look at Kuwait, Dubai. They went to the tourism side. They knew that, it wasn't going to last forever with oil. And they tried to do it that way. Property, high-end, travel. Everyone knows that, oil is a limited resource, but it's our own laziness and greed and the oligopolies and the control from government that are stopping a substitute for oil being found. Simple as that. I'm pretty sure if there was a hydrogen car available tomorrow and it cost a third of the price to fill up with hydrogen, everyone would have one. I would. Why wouldn't you? Simple as that, isn't it? But, it's having these things to buy. So it's down to the government still, and it's down to, the bigger picture. Unfortunately, while we've got this reliance on fossil fuel, there's very little we can do. So starting to a little bit bounce back in the S&P, we're getting towards that lower bowl. Still tempted to get into this euro and buy it down here. I mean, there's just so much resistance down here, kind of, 138, 29, 25. So let's just grind down a little bit lower, and I'll certainly be tempted to have a buy, because it just, there's only so far a market can move in an hourly candle. I'll say this now, it'll probably dip all the way down there to 137729, but, I'm not trading any particular big sides right now. Okay, Joe's just saying, Aussie US dollar looks like a possible reversal. Yeah, we can have a look at that in a minute. Let's just bring that up, actually. So you're looking at the Aussie US dollar. Wow, you're not wrong there. Well, yes, absolutely. We've got pressure all the way down to 0.90041, but a nice level here. A nice kind of daily support level at 0.90557. So if we don't close much lower than that, definitely a little buy above that could be to see us getting back into the range. So yeah, definitely good shout there. And Linda's saying the dollar, Japanese yen. We're going to see a lot of movement in dollar yen, because obviously, like I said, with China and people getting in and out of the big currencies. Oh, come on, eyes, don't film it out. Dollar, Japanese yen. So I hate this market watch. Come on, Stephen. There it is. US dollar, wow, yeah, absolutely. Well, we can get all the way up to 102, spot 827. That's, again, continued pressure. I mean, this is the big players in the market. This isn't natural, this isn't natural, okay? Nothing particularly, was said at the Fed meeting that wasn't really kind of expected. So this is just, the big currency players probably unwinding and getting into positions before the speech. But I would say, yeah, I mean, what we could do is go into the smaller time frames, I would say, and just do the old Fibonacci. So when you see this, again, what you're looking for are these low points in the market to go from. So you think that's the low now, then all you do is do a Fibonacci on the 15 minutes and say, right, we do find a solid point of support down here on the daily at 0.90557. Then the 50% is where the market naturally should aim to get. So do the same in euro dollar. So 50 minutes. That's the high, that's the low. Then again, if we find the market doesn't get to these lows down here, or some good areas to buy, then the market is going to push back up to the 50%, which ties in really with this weekly resistance down here. So, really at 13892. Is there enough strength to get the dollar up to 102.827? I'm not entirely sure, but you don't know. We've already come quite some distance already. And again, when you're talking about the big players, we can push the markets as high as we want. So we've got nearly 75 ticks, 80 ticks. So are we going to be able to get another 40 ticks? Well, quite easily. So again, if we find good support here, I would say in the Aussie dollar, then that for me could be a nice little buy, trying to get back to the 50% or at least the 38.2. So that's your 15 minutes. So if you think that's the low, then the fib will come into play. Likewise, if you think that's the low in the euro dollar, 50%, you know, that's another 40 ticks we could potentially make. Let's have a look on the 15 minutes. So same kind of scenario. 15 minutes, I would just do the fib. I don't know, what I'd do is the fib here. So I'd expect that if we find support here, then the fib's going to get us all the way up to here. Because we've got to think that although, you know, we're looking for that initial spike back to get to the 50%, then it's generally a continuation pattern, isn't it? So generally we're going to get to the 50%, then the market's going to make new lows. Go back to the 50%, make new lows. Because again, we're going with the original direction of the trend. So what we're looking for is we've missed the initial move. So we're trying to either buy back to the 50% for a small spike up, or let the market fail to get to the 50% and sell, knowing we're going to make fresh lows. So that's how you trade the kind of 15-minute views. Okay, so we go green on the Aussie dollar, then it's going to have to try and get up to that 50% or at least these lower fibs. And each time it fails to do, that's telling you that the overall trend will take over and we will make a new low. Same thing in the euro dollar. We're going to get to 28.3. If we get above that, get to 50. If we don't break above 50, close above it, then the market might tend to make a flow. So same scenario. I've just done a bit of a potential of where I think the market could get to and base my 50%. So I think if the dollar yen holds above 50% in this 15-minute, then we make a new high. Okay, so just different ways of using Fibonacci. You know, this is exact science, but it still does work very, very well. So that's your pivot point here. Here's your pivot point here. And here's your pivot point here. Okay, so if you want to know what's going to happen after the Fed meeting or later on tonight, take a screen print now. So if you don't get back above and close below that red line, market makes a new low. If you don't get above and close above that red line in the euro dollar, market makes a new low. Okay, if we hold above that 50% line, or maybe the 61.8 on the dollar, we'll make a new high. I'm into these 50-minute charts. So you can either buy back to the looking for a retracement, or wait for the market to go up and sell the high for the original trend. Okay, because this, whatever's been in the market, though I don't think is particularly earth-shattering, breaking, it still has sent the big players into taking position. Normal market participants, you and I, buying and selling. This is central banks, hedge funds, and the big players. So can you share your insight in the Euro CAD? It continually post highs in 2009. Yeah, I can. You can. Dollar CAD, you know, monthly highs, weekly, daily. So if we close below that, market's going to get down. There's no real support above that at all. Seen a big spike up. You know, again, I was looking at this other day, actually. That was a really good place to buy up. You know, again, the market then comes down, spiking back up. So the real point of interest is this month. So I'd say if we close below that, we're definitely going to try and get back to the moving average and get back in. Because we've already had this big up move. We've already then seen everybody take it. The market make these highs. Bit of profit taking up here, but then a continuation. So I think we're going to see big profit taking if we close below this level here. But again, when you get to new highs and you get to strength, I don't have any previous levels to go off. So if I don't have any previous levels to go off, I stay out. So although we've seen a lot of strength against the CAD recently, it's got to turn and reverse at some point. And what I would do personally is, if we, you know, the only monthly level and weekly and daily level I've got is here. So if we close below that, then if we don't quickly get back into the range, I'd be buying, expecting the market to break up and find new highs. And the only way you'd understand where the market's going to go to is maybe do a fib extension. So I just do here. Market really starts here, okay, going up, and we don't ever get back to that. So I would say from here to where the market found relative resistance, and surprise, surprise, in that spike, we've hit that. Okay, so I would say that the market, if it does continue, the dollar's going to strengthen to 1.3 to, what's that, 13236. Okay, so that was just me doing a Fibonacci. I was looking at the chart, the Fibonacci extension of this up move to where we've found support and resistance, tied in perfectly to the high we've just made. Isn't coincidence. Fibonacci works 80% of the time. So if we find real resistance here, market gets down, closes below this monthly level and comes back down to this 100%, this 61.8, or if we break above, the dollar can still potentially, because we have no real levels, go up another 80 ticks. Okay, so if you're going to take a screen print of that, that's your levels. Okay, rather close below this and make room back into the range and come down. If we close above this, then market goes up another 80 ticks. Okay, so that's your levels right there. Okay, so that's all you can do is take a screen print of that if you're interested in the dollar versus the CAD. Okay, so looking back, indecision. So I'm thinking new lows in the euro, but again, we're going to have to wait 4 minutes or so for the Yellen speech. But we haven't made any inroads to try and get back to that 50%, so we're still looking very negative Aussie versus dollar, very negative Aussie versus euro versus dollar, and I'm still maintaining that we're going to hit some highs in the dollar versus the Japanese yen, and that would be up here at 102.855. Get above that, some big levels up there. Okay, George just saying, is there any chance of the US dollar to wake up from its lethargy, or is it fall will just be an opportunity to short it again for better positions? Well, I mean, the thing for me is I'm always dollar positive in some respects and always buy dips because the world, relies on its currency. All the commodities are priced in dollars. It's still one of the major currencies that's spent and accepted all around the globe. So it's not going anywhere. And just because China might be, unwinding, and these are rumours, I've not been told by the Chinese government they're doing it, but if the Chinese government are unwinding into dollars and put it into euro, that's fine. But I still believe the US economy is stronger than the European economy, so I will always be buying dollar dips and selling spikes in the euro. That's just the way I look at it. Okay, guys, well, interesting session. I mean, there wasn't really an opportunity for me personally to kind of get involved and make some money, but anyone that says that, an unchanged Fed decision isn't something to trade, well, there we go. I mean, this is now, 3 or so minutes before Yellen is due to kind of release these minutes and speak, then anything could happen. It looks bullish for the dollar, and that's why I'd probably certainly go back and revisit the S&P, because I'd definitely be looking to buy some dips in the S&P. But then again, that's all part of the market sentiment. If everybody thinks that, yes, that was good news, then if the market does start to go down, people buy more and the market pushes further down to get people out. So it's the short term you have to be aware of. The short term trading is the most difficult because it can get manipulated, especially if it's not moving for the reasons that you understand. So realistically for me, I think we're going to hover around these levels for the next 15 minutes, see what's said from the meetings, but your pivot points are here, these 50%. Okay, right, so take a screen print, everybody. We've got 73 people here. If you take a screen print, and I guarantee you, I can't guarantee anything because I'll probably get fired for saying that, but if we close below these pivots, make a new low on the hourlies, close below these, on the euro dollar, make a new low, and likewise, we hold above in the dollar Japanese yen, and the dollar makes a new high. Okay, these are the pivot points you need to look for. And remember, we might need 1, 2, or maybe 3 hourly closes, but these now are your pivots. The market, all it can do is get back to that 50% or make a new low. This can only get back to 50% and make a new low. So in all these trades, you've got simple risk reward and a simple strategy to build. We either go up 17 ticks or we go down 20 ticks. From this point now. And how it does it, I don't know. How the market will react if it does a couple of candles or one big candle and down, I don't know. All I'm saying is from this point, the market's going to make new lows or get back to the 50%. That red line. That's all the market can do. And that's just Fibonacci, and that's just basing it on 1 15-minute candle. I've just taken the extremes of the 15 minutes into consideration. But Fibonacci doesn't lie. Okay, it's one of the most powerful tools you can ever use as a trader, and you have to use it in the right way and on the right time frames. Because if you don't, you always get caught out. That's why I've got such confidence in my levels and such confidence in the way I trade, because my levels generally work, because I program to pick out the things I always look for in trades, and the hourlies really are great. Well, there we go, George. When things tie up with, moving averages, or they tie up with other, technical analysis, that things have got, the markets like things to tie up, they like them to be clean. So confirming indicators are great. So we're going to see a new high. Now, we've seen a new high. There we go, in the dollar Japanese yen. As I said, it might be by one tick and it might be slowly sustained. But look, where do we close? Above that 50% that was already drawn in, and I said what was going to happen. Have we made a new low? Not just quite yet in the euro dollar, but it's coming. So the same scenario is probably going to happen in the Aussie US dollar. That again, we test this low and come back down. So if we get new lows in the euro dollar, it's going to get down to 1.3818 or 1.38250. Okay, Steve, which indicator do you use for fib levels? Well, to be honest, it's a combination. It's a combination of about 4 or 5 different factors, to be honest. So I couldn't tell you offhand. I wouldn't tell you anyway, because it's my formula. It's how I view them. But you can just do them yourselves, based upon any volatile candle. So the volatile candle is this one here. So just do a fib from the low to the high of this. Then that'll give you a 50% target. So we've only made a new high in the dollar versus Japanese yen by 1 tick. But, again, it's still could have bought and made money here. But if we're carrying aggressively up, then again, my level is 102.856. That's where I think the dollar can certainly get to. Still looking like, a lot of volatility here. But if this euro makes a new low here, it's definitely getting down to these lower levels. And, if we do really kind of smash through these low levels here, then, I wouldn't be surprised if we get down to 1.37729. Penny against the dollar, I'm not entirely sure, to be honest. I mean, I'm kind of on the edge of time at the minute, guys. So I don't really want to I don't know if there's any other scheduled webinars or anything else we need to kind of get out of the way for, I'm afraid. So I don't want to step on any other presenters' toes. Like I said, we've got enough to focus on now. We've got the Aussie dollar, we've got the euro dollar, and the dollar versus Japanese yen. The S&P and Wall Street is probably going back up. I'm still looking to buy some dips down that, but we're still seeing a bit of weakness in the FTSE. So a mixed bag in indices. But what I'm focused on is our fibs here. Okay, so the thing is, a double bottom here in the euro dollar. That can be quite easy to break. But if it does find support down here, and it is a double bottom, you're 50%. I guarantee that it's going to try and attempt to get back to that in the same scenario in the Aussie dollar. Okay, guys, well, I think a good session in all. We've got a bit of live charting, a bit of real-time analysis. It wasn't really as bad as anyone said. Let's see if anything major or concrete comes out from Yellen. I suspect there'll be a first, kind of speech. Nothing amazing is going to happen, but it doesn't matter what she says. The markets will interpret what she says in any way they want, and they'll interpret it with their feet. They'll vote with the money. So she might not say anything that, the economy's better, or the economy's worse, or she's going to do this, she's going to do that. Whatever she doesn't say will be taken into the account with the market, because the markets will read between the lines. That's what speculators and traders do. You don't have to say anything, do you? You don't have to say anything for people to trade again. So we made that new low in the euro dollar, as I said. Again, held below the 23.6, new low made. So I'd say that it's almost a certainty that we're going to make a new low in the Aussie versus US dollar. And then with great lower, they kind of levels down here. Okay, so it's coming. And here's your levels in the, again, I mean, they might not bounce off them, but they're certainly going to pause around these levels here. But when we haven't gone back into the range of the candle, I wouldn't be buying these now. I just think the market, again, if it's going to hit down hard, it's going to just do what it did here. It's going to break through the levels and just continue. We're not going to see any kind of, euro buyers until we reach really, really, really low levels. Again, I'm massively bearish the euro anyway, so why would I buy it anyway? I still would buy the dollar anytime over the euro. But again, I'm just trading off the charts. I'm just saying that, if we move down, 100 ticks in space of 2 hours trading, it's probably going to go and bounce 20, 30 ticks up, because people have to take profit. Okay, dollar, Japanese yen sell now. Possibly. I wouldn't sell it till we get back to 102. If we get back to 102.253, then I'd sell it. Simple as that. We made the new low in the euro dollar. So again, if we don't continue to move lower, definitely get back to the 50%. And again, I still think we have to see a new low in the Aussie dollar before we get back to 50%. So, okay, guys. Well, listen, absolute pleasure. Plenty of things coming up in the future on FX Street. So again, tune in if you like the kind of my style. Again, do support me. Like and share anything of mine on Facebook and Twitter, and anything you see on my page, FX Street. Been writing a bit more recently, so things to read up on. If nothing else, guys, it's been an absolute pleasure. Okay, well, good luck with whatever Yellen says, and any questions or any thoughts you've got, just tweet me at Steve Ruffley. All right, guys, take it easy. Thank you.